Hi, I'm Dr. Jeff Camarda with a word from Jeff, this time on how to pick stocks now. As the U.S. markets continue to defy gravity in late April and early May, political, the shoe dropping notwithstanding, at least at this point, a number of caution flags are briskly waving. For instance, the number of investment pros who believe the market is overvalued is now at something like 90%, and haven assets like gold and low-interest bonds are attracting major cash flows, thought by many observers, by the way, to signal trouble ahead. Not that I think that these are good investments, goodness no, just danger signs flashed by the skittish. Still, as is often bemoaned, the market can stay irrational longer than you can stay solvent, and the levitation may continue for some, even a long time. Still, Camarda expects a healthy correction in the short term, but continued strong advances in the long term. We expect the U.S. market to do well, and many non-U.S. markets to do even better, probably much better going forward, and I mean for years now. Particularly in a market flirting with overvaluation, bargain hunting for undervalued gems can have wide appeal. It does not seem possible to overstate the importance of owning the right stocks in times like these, and index aficionados should take serious note. For instance, through early April, only 10 stocks in the S&P's mighty 500 were responsible for 50% of the index's gains. In other words, just 2% of the stocks in the index produced over 50% of the gains. And this is fairly typical in that the 10 best stocks usually produce around 50% of the gains. Obviously, stock picking, if you can pick them right, makes a huge difference. Obviously, the other 490 stocks contain a large number of mediocre or worse stocks that index investors are saddled with, or perhaps kenneled with. Index investing is mechanical and mindless from a stock quality standpoint, and most investors probably don't realize how many hounds are baying in their cheap index funds. Make no mistake, no one in index funds is screening for good value or strong upside or any validation of stock price at all. With index funds, and they are huge and powerful, when they get money, they must buy the whole index at whatever price and regardless of valuations. They have no choice. They have to buy what's in the index, whatever it's valued at. This buying pressure can drive prices up, even to overvalued levels. As index funds increasingly dominate the markets, as they become the markets, there are fewer and fewer smart people doing the research that helps set prices based on attractive value. A recent academic study out of Notre Dame suggests even some 75% of active funds are really stealth index funds, compounding the problem. And the problem is, of course, that index fund values can become increasingly untethered from reality, until the music stops, that is. Another study shows that active management, the kind of stock picking that Camarda does, tends to deliver even better returns in challenging markets, such as corrections and bear markets. So how to pick stocks now? Look for deep value. Look for stocks trading at a discount to their intrinsic value based on profits, cash flow assets, and other measures. Invest like Buffett does. He once put it this way: long ago, Ben Graham taught me that price is what you pay, but value is what you get. Whether we're talking about socks or stocks, I like buying quality merchandise when it's marked down. Amen to that, Warren. You're certainly preaching to the choir here. Buffett's cohort, Charlie Munger, looks at it like this: all intelligent investing is value investing, acquiring more than you're paying for. You must value the business in order to value the stock. Especially now in these overvalued times, we believe this wisdom is the surest path to investment success. Hopefully you suffered through that. It was a bit long. Hope you found it useful. And until next time, thanks for watching. I'm Dr. Jeff Camarda.